The change in your tax filing and moving from your working years to retirement is a little bit like the change in your breathing when you travel from Lhasa, Tibet at 12,000 feet down to Beijing at 200 feet. You're likely to breathe quite a bit easier. There are a lot of different moving parts, and today we'll unpack many of the differences that you can expect in your taxes moving from working years to retirement.
All right, so Spencer, you lived in Lhasa, Tibet for a couple years, and then you would have times where you would travel down to Beijing. And for those of you that don't know, if you move from 10,000, 12,000 feet to sea level, there is a big change. Just like when you move from a high tax situation, maybe in your working years, you're at your prime working years, you're earning a lot of money, to maybe then you are not, you're just living off of savings for a couple years. There are lots of changes when it comes to income tax and retirement. So we want to talk through some of those today. So what are some key considerations that people need to know before we get into some of the details here?
Big picture, I think we think about a handful of things. First, we don't have earned income anymore, and that can be quite a bit different in its taxation than retirement income. We also maybe don't need quite as much income because of some of the shifts in the life circumstances that we have. So we might not be paying for college or for a home mortgage or some of the other things. And that can have an impact on how much income we need and therefore how much tax we have. So there's a number of different moving parts, and we'll kind of move through these sequentially today to talk about each one.
Right. And so kind of as you think about that, if you imagine having $100,000 of income right now, and you're thinking, well, I need to replace $100,000 of income, that's where as we work with clients and say, well, actually, you're paying 7.65% on FICA. If you're self-employed, you are paying 15.3%. And so, yes, you may have $100,000 of income right now, but if you take off 7.5% or 15%, that's a big change. So talk us through FICA and how that one really affects retirees.
Well, that's the biggest one, and it's one that folks oftentimes just somehow mentally forget because we don't see it necessarily unless we're looking at our pay stub. So it's payroll tax. It is 7.65% on the employee side, 7.65% on the employer side. So over 15% altogether. For those of you who are self-employed, you probably feel the bite of that a little bit more than the rest of us. But again, 7.65% for most folks as they see it come out of their earnings for the W-2 that they might receive there. And we look at that particularly up to that first $168,000. It's a little bit less thereafter. You're just paying Medicare side of that. So for earnings that are above $168,600, you just have on the employee side 1.45% on Medicare. And then there is a little bit extra. And sometimes, again, folks forget about this, but if you have earned income north of $200,000 as an individual filer, you're typically paying that extra 0.9% for Medicare. And then if you're over $250,000 married filing joint, again, you're paying an extra 0.9%. So that is not a huge amount in the grand scheme of things, but 7.65% on the bulk of earnings for a lot of people, that can go a long way.
Mm-hmm. Yeah, and if you think about it again, if you've got $100,000 of income, gross income, you that's what you take home. Your net is obviously less than that, but you take away $7,650 of FICA tax. That's a nice savings that you get. So the next one is Social Security income. It's not fully taxed up to 100% of it. So you want to walk us through this.
And there's the most variance in terms of how much Social Security income is taxed. We've done a whole episode about provisional income and how we calculate Social Security tax and those kinds of things. So we'll put that link in the show notes for sure. But on the high side of things, if you have a very high level of income, say from pension and Social Security, the most that a Social Security amount of income will be drawn in to be counted as ordinary income will be 85% of that Social Security being included in ordinary income. So the good news there is not all of your Social Security income will be taxed. At least 15% of it will not be included in the tax calculation on that highest of SAD. So you get a little bit of a benefit there, all the way up to, if that was your only level of income, you might have a significant benefit there because Social Security, you might have $60,000 of Social Security income as a married filing joint couple, have no other level of income and have no tax due on that Social Security. So there are circumstances there where that Social Security can be taxed at a much, much lower rate than what you're accustomed to with your earned income.
Yeah. So let's talk about this next one that is often missed, is the standard deduction increases if you're over 65. So talk us through this a little bit.
It's fairly straightforward, fairly simple. You're just getting an additional level of standard deduction. If you are married filing joint, then each of you and your spouse each have another $1,550 in 2024 that's being added to that standard deduction. So it's about $3,100 that's additional standard deduction. If you're an individual filer, it's $1,950 that is, again, added to your standard deduction. So it is a nice bump. If you look at that, it's going to save you some in taxes, but it's probably not going to alter your financial plan in a huge way.
Okay, so let's move over to state income tax. We've talked about this a little bit before, especially when we were talking about relocating. We talked about state income taxes, but talk us through that and how that affects when you think about retiring.
Well, so for state of Tennessee residents, we're fortunate in that we don't have an income tax, so we don't need to worry about this. For some other residents of other states, it can vary. They may have state income tax, but we may not be including Social Security income, or we may not be including Social Security income and pension income, or we might not be including any retirement income into that state tax calculation, or we might include almost everything in that. So it varies by state, but usually state income tax is going to be a bit lower because things like your Social Security income are not going to be included on that state level. So generally, state income tax, if you are in one of those states that you have state income tax, generally that also drops in retirement.
Yeah. Okay, so talk us through the next piece here. Some accounts will have distributions that are either not taxed, like Roth, or taxed at a much lower level. So think about capital gains on non-qualified accounts. Can you talk us through how that shifts in retirement?
Yeah, so we just think about, again, if you had $100,000 of gross income, you're going to pay a certain amount of tax on that. You're going to have FICA and other federal tax and so on and so forth. If we think about having, say, $100,000 of income, and let's say that half of it comes from Social Security and another half of it comes from a non-qualified account because we're taking distributions from a non-qualified account, let's just say first in retirement, you might have a very low level of taxation there because you've already paid taxes ostensibly on those non-qualified assets. So you might have a little bit of tax that's due each year on the interest income from an account like that. You might have a bit of tax that's due when you sell some of those resources for usage in retirement if you have some capital gains on that. But the long-term capital gains rate is below the ordinary income tax rate there. So even there, we tend to see a lower level of taxation. So let's just say, again, say you have $100,000 of taxable income this time. So we have probably a higher gross level there, but $100,000 of taxable income, and we add another $10,000 of long-term capital gains, well, you're probably going to be taxed at a federal level of 15% on that. But you would probably be taxed at a higher level in terms of ordinary income. Typically, in 2024, that would be a 22% tax there if it's taxable income, again, taxable ordinary income, and we're north of $100,000 there. So there's a delta in there. You're not usually taxed as much on those non-qualified accounts. Of course, for Roth accounts with qualified distributions from Roth accounts, we don't have any tax that's due on those. So we have to be careful about where is the money coming from as we think about tax projections and calculations and those kinds of things, but tends to be, if anything, less than what we've seen during our working years.
Right. Okay. So let's shift now from just earned income taxes to ways that we can utilize qualified charitable distributions. So oftentimes in your working years, you are earning income, you're bringing it into your bank account, and then either you're pushing it to a donor advised fund, you're doing that, or you're just pushing gifts charitably out. So you're paying income taxes as it comes in, then you're making the gift, and you might get some deduction from that if you are over and above that standard deduction. But oftentimes clients don't see any tax benefit from charitable giving because the standard deduction is high right now. Qualified charitable distributions are a great way to not recognize that income. So if you're over 70 and a half, you can make gifts directly to a charity from your traditional IRA. You never realize the income. The charity gets the money. They never pay tax on it. And so it's a way to continue making those charitable gifts, but never realizing that income. Any other thoughts on qualified charitable distributions and how they affect retirees?
Well, I think you hit the nail on the head. If we're just looking apples to apples, and let's say we've got $100,000 of income pre-retirement during our working years or post-retirement there, then, if we are during our working years, we've got to declare all of that income. There's really no way around that. It's earned income. It hits our bank account. We write a check to those charitable institutions, and we may or may not get any deduction for that. I mean, standard deduction pushing up on $30,000, this year. So we may not get any credit for it. Whereas on the qualified charitable distribution side of things, even if we make a gift for $500, the apples to apples comparison there is, well, instead of having $100,000 of income, now we're only declaring $99,500 of income. So it's much easier to get some benefit for the charitable gifts with those QCDs, as you mentioned.
Right. So you mentioned this at the top of the episode, but we'll come back to it now. Some of these replacement income things we may be dropping off. So we think about mortgages, kids may be out of college. What are some of those things, and how do those affect planning?
Well, they can lower our tax bill because we just need less income. You think about it, and let's just say again, to keep the math very easy, you have $100,000 of income and you're paying on a mortgage. And so let's say $20,000 of that 100 is going to go to a mortgage. Let's say another 20 goes to the government. Let's say you have one child under the roof or paying for college, and you're devoting another $15,000 there. If those roll off the books, if we say, okay, well, we are not going to be paying for a child's education anymore, that $15,000 in that example, and we're not paying for the mortgage anymore, that's $35,000. If we don't have to take out those funds from an IRA to make up for that, and let's just say again, we're paying at some kind of a clip, might be 22%, as a marginal rate on that $35,000 that we no longer need because we're not taking it out anymore. 22%, we're saving something $7,000-8,000, in taxes, and it's not necessarily just reducing our tax bill that we're looking at there. It's just that we don't need to take out the resources for the same lifestyle. So it does, in effect, kind of have a backdoor influence in reducing our taxes.
Right. And so the other one that we think about is you're saving into retirement right now. So let's say you're maxing out or getting close to maxing out your retirement accounts. You're putting $20,000 in. Well, now there's not $20,000 that comes out of your gross salary to go into retirement savings. So, I think what's really helpful for clients is as we lay this out, as we write these things on the whiteboard of, hey, you've got $100,000 of gross income. You're pushing $20,000 to retirement savings. You've got another $7,500, $7,650 that's going to FICA tax. You also don't have your mortgage anymore. It starts to really clarify this picture of, well, maybe my retirement distributions don't actually need to be as high as my gross income right now. It can really clarify things for clients. What about healthcare expenses if you're switching to Medicare? How does that affect retirees?
Well, again, mileage varies here. Oftentimes we find that retirees, as they go on to Medicare, their health expenses, their healthcare coverage expenses overall will drop in terms of the global number there. Now, sometimes, again, that's different. Some employers in our area in particular have really, really strong health insurance plans during a client's working years, unusually strong. Most people, though, they will not have as strong plans during their working years as when they get to Medicare ultimately. So for anybody that's on a marketplace plan or comes from maybe a typical employer and going to Medicare, Medicare is probably going to reduce those costs. For a handful of folks, it could actually be not quite as strong a plan, but it's still, there's a lot of benefits there in Medicare.
Yeah. Okay, so we've walked through several situations where your taxes could decrease and likely will decrease in retirement, or what you see coming out of your gross paycheck is going to decrease. But let's talk about some situations where the reverse might be true. So you move from a low tax state to a high tax state. How does this affect people?
Well, first we have to ask, What are you doing? No. What we're actually looking at is that you probably have some kind of family or relationships with folks, and you're moving in that direction with intention, but you are knowing that you're going to have higher taxes. So if you moved from, say, Tennessee up to New York, you're going to pay a lot higher taxes. We sat down with clients for financial planning that was moving from Tennessee up to New Jersey, and they knew very well that they were going to face higher taxes, in the midst of that transition. So when we look at that, there certainly are states that are higher than others, and if we're moving from Tennessee to California or into the Northeast, typically those expenses on a state level at least would increase. On a federal level, they might still decrease because we'd have Social Security and other taxes that would be dropping our level of ordinary income there relative to what we see right now. So it could balance out. It could even be less on the grand scheme of things, even though we're moving to a higher tax state, but it's going to be a mitigating factor.
Right. Okay. So the next one, you receive a lump sum of deferred compensation in your first year or two of retirement. Talk us through this situation.
Well, there are some employers that offer plans that they're going to have some kind of incentive structure where they pay out at the very end of working years, or maybe even into a year after one's retirement. And so in that kind of circumstance, you might have a higher level of ordinary income there. Let's just say that deferred compensation was $500,000, and you worked up until the end of December one year, and that lump sum was paid out at the beginning of next year. Why, your first year of retirement, you might have much higher taxes if you were making a couple $100,000 a year, but the deferred comp was double or triple that.
Okay. What about situations where income increases in retirement due to higher withdrawals? When do we see this happen?
Well, every now and then we'll see situations where maybe someone was living quite frugally during their working years, saving a whole lot, and they get to retirement and they say, okay, there's 6 trips that I've wanted to take, and I'm going to take them over the next 2 years. And so they take significant distributions in retirement, say from a traditional IRA or traditional 401k, and that increases their ordinary income dramatically. So, or it could be that they have a home remodel, or they have, other things that are financial priorities based on their core values, based on their life plan, that might increase that distribution and create circumstances where their taxes go up for a season.
Right. Okay. This next one, distributions that have penalties. So if you have been saving into maybe, let's say, a 401k plan, but then you decide to roll it over to an IRA, not knowing about 55 and separation of service, and you want to take a distribution at age 57. Talk us through what penalties are incurred therein.
Well, usually if we've got penalties in a retirement account, you're looking at something like a 10% penalty on the amount that's withdrawn. So there are ways that if we do planning, oftentimes we can avoid this, whether it's a 72T distribution or whether it's 55 and separation of service or some other maneuvering where we can try to keep clients from taking distributions in a non-qualified manner. And typically this would be taking significant distributions prior to age 59 and a half from accounts that the distribution is being treated as a non-qualified distribution. But that can create quite a spike, as you might imagine. I mean, if we had a client that said, well, my happiness in life depends on me being able to take out $200,000 from this IRA to be able to purchase this home, and they're age 58 and this is not their first home, there's no other, mitigating circumstances that we could, even get some help on, then, they're going to pay through the nose because of that penalty.
Right. Okay, so the last one here is between pension, income, Social Security, RMDs, income might be higher than you expect it to be. And therefore your income might be higher than your working years. So talk us through that one a little bit.
Well, for people, again, that have saved remarkably well, sometimes stacking up Social Security, pension income, required minimum distributions, they might even have more income there. It certainly is not the norm, but it's not that uncommon, particularly for folks who work in the governmental sector and may have really strong pensions and may have had a long tenure of service. I remember we were sitting down with a client a number of years ago and realized that the local pension, Social Security, he was going to be making more just from the local pension and Social Security than he was through his earnings. And so my dad joked with him that he wanted to thank him on behalf of the taxpayers for working as long as he had, because he was actually in one of those circumstances that, it was almost detrimental that he worked the last couple of years of his career, because he didn't get that much of a bump in his pension, and his retirement income was actually higher than his earned income in his working years. Right. So there are circumstances like that, particularly when we think about folks that have saved really well into traditional IRA, traditional 401k. So, let's just say you've saved quite well and you have $3 million in an IRA, and you've got required minimum distributions on the horizon. You're going to have to take out, if you're taking out 4%, let's just say, you have to take out $120,000. You add that to your Social Security income, potential pension income, you might have more income there than during your working years, depending again on what your salary is during your working years and how much was being saved and those kinds of things.
Right. Well, Spencer, thanks for walking us through all those situations. The reality here is there are a whole lot of implications to retiring when you think about the tax picture. And so for clients, we would love to talk with you through what this looks like, how FICA is going to drop, how these other elements are going to affect your specific plan. With all of these, we say we are not CPAs, so take all of this information to your accountant, to your financial professional, and we look forward to seeing you again next time. Take care. If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.